Hi everybody, this is AJ speaking. Today I wanted to discuss with you whether Palantir is still a good investment. At time of recording, Palantir trades at $104 per share. The stock is up over 500% over the last 12 months, and the company is currently valued at just under $240 billion. Palantir reported just a few hours ago. This is a look at the just presented income statement. You can see here the key income statement lines through which we will go in this presentation, and we'll forecast them. The net income attributable to common stockholders was $79 million for an earnings per share of $0.03 per share. However, the number that we want to calculate in this presentation is the adjusted earnings per number. And when we look at this Palantir table, you can see here the 79 million of shareholders net income. We have to make a couple of adjustments, so we have to forecast all these items. And you can see in Palantir's case, these adjustments are quite significant relative to the net income. For example, Palantir is extremely generous, I would say, in compensating employees with stock. You can see here the 281 million charge in stock-based compensation that is being added back. And then there's some other adjustments related also to the share-based compensation and some other tax items, which we'll discuss later. And we get to an adjusted income number of 342 million. So you can see the discrepancy between the GAAP net income and the adjusted net income is ginormous. And therefore the EPS delta is huge. The unadjusted EPS was, as we said earlier, was 3 cents, and the adjusted EPS was 14 cents. And the valuation that I present later will be based on the adjusted earnings number. Keep that in mind. The implied multiples that you will be looking at later otherwise will be much, much higher than they already are. Then before we start with the forecast, take a look at the outlook. This is also what was presented, and the company expects revenue of 3.741 billion to 3.757 billion. I find this a little bit of a ridiculous range because there's literally, what is this, a 16 million delta. So why not call it, 3.7 billion or 3.7 to 3.8 billion? This seems like almost a lapse. Anyways, no big deal. And then we have adjusted income from operations of 1.6 billion to also, it's 1.6 billion effectively rounded. Also a tiny range. This is very odd, such close ranges. To be honest, in my 25 years of analyzing companies, I'm not sure if I remember such narrow ranges of such large numbers, because on a percentage basis, this is almost nothing. So let's dive right in. So on this first slide, you can see, first of all, the total revenue projection per quarter. Here the darker blue bars are the reported numbers. So for 2024, the company reported $2.87 billion. It's an almost 29% year-on-year growth rate after almost 17% year-on-year growth rate in 2023. As you saw earlier, the company expects for 2025 approximately 3.75 billion. This is the guidance down here. However, the forecast is ahead of management guidance and runs on a 2025 estimate of 4.01 billion, and this implies a 40% year-on-year growth rate. This is a growth rate the company has never delivered. And when you look at these boxes up here, you see the year-on-year growth rate per quarter in green, and then in this light purple, quarter on quarter. And when you look at these year-on-year numbers, you can see these are 40% in each quarter. This is the growth assumption of this forecast. And when you look at the historical growth rate, this is a growth the company has never delivered. So the forecast is clearly significantly more aggressive than both historical deliverance plus management guidance. So just keep that in mind. Then we look at the gross margin. So the gross margin used to increase from mid-2022 to 2023 peak in the last quarter at 82.1%, which is very good, which is somewhere around Meta's gross margin. And then it kept consecutively decreasing in the subsequent quarters to a, let's call it interim low of 78.9% in the most recent quarter. The forecast assumes that sequentially the gross margin keeps going keeps getting back up again, and at the end of the forecast, end of 2026, the forecast assumes just under 81% gross margin, so near historical highs. And keep this number in mind, because later we'll compare this with some other companies. Then what does this translate into in terms of gross profit? We forecasted the revenue line, the gross margin. Now we can derive from that the gross profit, and this is what the result looks like. So in 2024, the company reported 2.3 billion gross profit. The forecast on the gross margin assumption and revenue assumption implies 3.2 billion. That's almost 39% year-on-year increase in gross profit. And then the forecast implies another almost 42% year-on-year increase in 2026. And please note, this yet again is growth never delivered by the company, significantly ahead of what the company ever delivered. So you can see this is not a conservative forecast. Keep that in mind. Then we look at the key expense items, and so one big one is selling and marketing. And on this chart, I expressed selling and marketing expense as a percent of revenue. As you saw earlier, revenue is expected to grow very quickly. At the same time, due to economies of scales, etc., this forecast assumes that the selling and marketing spend per dollar of revenue goes down significantly to a level never seen before. This also would make sense, assuming the business continues to scale as forecasted. So you can see that we saw in 4Q this spike to 34.8%, but the forecast assumes that from 1Q it will drop down to 29% and will continue decreasing to just 18.5% in the fourth quarter of 2026. The other large expense item is R&D expenses. Here, the same methodology. Interestingly, we also saw a significant spike in R&D spend in the fourth quarter of 2024, but the forecast ignores that spike and continues on from the prior lows, and assumes further decrease in R&D intensity, which means the company will be spending less and less R&D per dollar of revenue over time. The exact same methodology was applied to general and administrative expenses. Same thing, we ignore in the forecast the recent increase, and we start off from the recent lows and keep and we assume general and administrative expenses also go down. So we apply for these three main expense items the same methodology. We assume significant economies of scales come through. And on this chart, you basically see the combined result. When you add these three main expense items together, what is the implied expense ratio? So on this chart, you see operating expense, which is the sum of the just mentioned three main expense line items. It comes down significantly to below 50% by year end 2026. In 4Q 2024, the expense ratio was almost 78%. So the forecast assumes a significant reduction in expenses. And then in terms of dollar spend, what does OPEX look like? This is what it looks like. You can see there's an increase in absolute amounts, which is also reasonable because we assume that the business is growing by 40% year on year, and this obviously will entail some additional hiring, etc. And then in terms of operating profit, you can see that operating profit dropped to just 11 million in the fourth quarter of 2024 for a full year operating income of just over 300 million. The forecast assumes that operating profit grows by 153, and sorry, this is the wrong way to put it. Based on all the assumptions that we discussed previously, the operating income that is generated by this forecast is what you see on this slide. So on this slide, there are no assumptions. It's just a mathematical or accounting result of all the things that we discussed before. And you can see the implied operating profit growth is quite substantial, 153% in 2025, and then another plus 119% in 2026 on top of the 2025 number. I'd like to point out, so you can see profits are really taking off in this forecast. Keep this in mind. This is a very aggressive forecast. Then what does this look in terms of operating margin? The operating margin increases to 34.4% end of 2026. In 4Q 2024, the operating margin was just 1.3%. In the prior quarter, 3Q 2024, the margin grew to 50.6%. And you saw earlier why this was. There was a significant increase in expenses across the board, across R&D, selling, marketing, etc. But the forecast ignores that increase in expenses, as I said earlier, and we continue on from basically prior levels. And again, this margin is implied from all the assumptions previously laid out. And you can see how the margin goes up quite substantially. But let's put this into context. So the margin is 34.4 at the end of the forecast. And how does this compare to someone like Meta? Meta, obviously, also a very large software company. And make no mistake, this is not a marketing agency. Meta is software powered. That's why they're so successful. And when you look at these margins, so the operating margin is this in this red or orange line. Meta currently is firing out of all cylinders. Meta's 4Q operating margin was 48.3%. But when you look at this trend line, there were periods where Meta was not too far off from what we forecast for Palantir to get to. But keep in mind, Meta is super large scale business, software business, and belongs obviously to the top companies in the world. And when we compare to a company that is even larger in software, this is Microsoft, and you can see that company has even higher operating margin. But during tough quarters, even Microsoft's operating margin dropped near the level that we forecast for what is still a relatively small company by the end of the forecast, which is Palantir. So keep this in mind. The margin we are forecasting for Palantir, even though it's still a relatively small software business by the end of the forecast, compared to these giant companies. So this is also shows you this is a quite ambitious forecast. So then next, we talked in the beginning about the company's share-based compensation, which is quite rich, relatively speaking, given its size. And you can see down here in 2024, they spent almost 700 million in share-based compensation. Just to give you an idea, Tesla spent about 2 billion. But Tesla is $100 billion revenue company. So makes, roughly 7 billion in shareholders net income. So a completely different beast. This gives you some idea. Share-based compensation is quite rich in Palantir. So, but in this forecast, we assume that the level that was sort of delivered in the fourth quarter of 2024 is basically maintained. There's very little growth in share-based compensation. And then when you take share-based compensation together with related expenses like taxes that are associated with share-based compensation, some other items, and you express it as a percent of revenue, this is what you get. So you can see 4Q 2024 was a massive outlier because of all these expense increases. But the forecast ignores all of that, and we assume that these expenses will significantly decrease and to just 19% of revenue by the end of 2026. And then on this chart, you see how the total share-based compensation looks like on an operating expense basis. Here again, we assume a decrease. Then after adding taking the gross profit into account, the operating expenses, etc., then we get to the profit before tax line. And here you can see that the company delivered just under 500 million in 2024. The forecast implies almost 115% growth for 2025 and almost 99% on top of that in 2026. So very aggressive. For example, the forecast implies sequentially, so in 1Q, a more than doubling of the 4Q profit before tax, which was just 81 million and was a sequential decline. Then to get to earnings, we also need to look at the tax rate, obviously. And thus far, Palantir, because of losses, etc., paid very little tax and for certain other reasons. And so in the forecast, what's happening is we assume the very low implied effective tax rate stays the same. So the forecast assumes just 2%, which is super low. But then in 2026 there is some normalization, which you would expect, driven by the forecasted earnings power, and that's why we have here increasing tax rate. However, this is still very, very low because S&P 500 companies tend to have close to 20% tax rate. So after applying the tax rate, this is the shareholders' net income that you get. And you can see the company delivered 462 million in 2024. Forecast expects a more than doubling, a plus 122% in 2025, and another 85% increase in 2026. However, as I pointed out earlier, for valuation, we need to go a step further. We need to adjust for the share-based compensation, which means adding it back. But before we get there, let's talk about share count. The share count, as you saw earlier, increased in the company quite substantially. You can see it here. So beginning of 2022, the company had just over 2 million shares, and that number rose by the end of 2024 to over 2.5 million. However, the forecast assumes, and here's a disconnect between the share-based compensation and the projection of the diluted shares. Here in this very aggressive and highly Palantir favorable forecast, we assume the company compensates for some of the dilution, and that's why we is assumed here a more modest growth in share count. Again, this helps the company in terms of valuation, i.e. makes it look less rich. I just want to point this out. This is a smaller point. I'm giving the company every possible benefit of the doubt in this valuation. I just want to point this out. And then we get to the diluted earnings, but this is still unadjusted, and you can see the EPS growth. So this down here is the 3 cents that we looked at the beginning of this presentation. Based on this forecast, this more than doubles in the next quarter, and then you can see how it progresses. And you can see in 2024. EPS was just 19 cents. The forecast implies an increase of to 40 cents in 2025 and then subsequently in 2026 73 cents. However, all of this is unadjusted or GAAP numbers, and that's why we need to make an adjustment. And after adding back all the share-based compensation, related tax effects, etc., just like what the company does, you can see it here. This is what you get. This is the implied EPS on a quarterly basis. Here's the 14 cents that we discussed in the beginning of the presentation. There's this huge disconnect between the GAAP and the adjusted EPS number, and this is also what the forecast accounts for. And then when we look at these adjusted numbers, the company reported 41 cents per share. The forecast implies 96 cents per share in 2025 and $1.29 in 2026. And you can see these growth rates. These are quite massive. And then to make these EPSs useful, we need to look at them on a next 12 months basis. The typical PE ratio is defined as the price divided by the sum of the next 4 unreported quarters, or short NTM for next 12 months. And this chart expresses that the earnings that we saw on this slides in terms of NTM. And when you pay close attention down here, the labeling of the x-axis has changed, because now this shows you the effective NTM when it actually hits the wire, because the company reports the fourth quarter, which ends in December, in early February. And so the NTM changes not as of December, because nobody knows the NTM at that point. It changes when the company reports. So the NTM is here shown based on when the company reports results. It is a more accurate way of doing a multiple. And as of right now, just post earnings, the current prevailing NTM is 96 cents per share, and you can see here. So I highlighted this here. Here, the darker bars is the actual next 12 months earning the company delivered, and we can only obviously do this till February 2024, because in May the company reported, and therefore after May, after 1Q 2024 was reported, we have only 3 reported quarters left from the company, and that's why to make an NTM metric, you need to complement it with a forecasted quarter. This is how it works, and that's why over time, as you go more and more into the future or to the present first, you run out of company reported earnings, and then you need to add more and more forecasts till you run completely out of company reported EPSs, and then it's a complete forecast, and this is highlighted above here. So the net result of all of this forecast of calculating EPSs as a result and then turning them into NTMs, and then also the share price dynamics of the stock is what you see on this chart. It's a little bit of complicated chart, but I tried my best to explain it. So first of all, you have 2 axes on the left-hand side and on the right-hand side. On the left-hand side is a share price. The company spiked to over $100 after fourth quarter earnings were announced. This analysis was done pre-market when the stock was at $99. So this, you see here a spike, and what happened is we have the next 12 months multiple. We have the next 12 months earnings based on the forecast that we just talked about. So we can now apply the NTM earnings to the current share price. And the resulting multiple is what you see here in red. It's 103.3 times. So that's the latest reading. But when you basically go back in time, you can see how the multiple developed over time. And if we go back to this analysis, you can see how the earnings increased. And if the share price stays constant, the multiple should come down. But the earnings increased, but also the company's share price kept increasing, and the share price increase, as you can see on this red line, kept outpacing the earnings increase. And that's why the multiple kept increasing, and that's why we are at this quite high level. So that is the next 12 months implied multiple, obviously the 103, but just to give you an idea, NVIDIA trades at around, you can argue, but certainly below 30 times. Apple trades somewhere around that range. Same Meta, basically all the leading global companies, they traded a third of that multiple. Or in other words, you saw the growth and everything that was baked into this forecast. You can see that this multiple is based on very aggressive assumptions. And very aggressive assumption is just another way of saying on very high earnings, and very high earnings bring down the multiple. But because the share price is so rich, the multiple is still very high, even though we forecast this very aggressive earnings ramp based on all this crazy growth, very favorable margin development, very favorable cost development, etc. So anyways, let's assume the stock can actually defend this high multiple, and the forecast that we discussed in the last half hour can actually be delivered by management. So what happens to the stock? And this is what this green line tries to plot. So this is mathematically very simple. So what you do is you keep the multiple constant, and then you express the line as a multiple of these earnings. And when you apply the multiple to the next 12 months earnings, this gives you the share price by definition. And this is what this line plots. Just one little technical note, you see that it's like it increases in stages. So what this green line does, it actually smoothes between the stages. So when you go from 96 cents to $1.04, it's not just taking the two values, but it takes all the values between these two steps. So it's like a smoothing. Doesn't change the outcome. It just makes it visually more sensible, because otherwise you have like a staircase shape. Anyways, it's just not important detail. So it's just so you understand how this all works. And basically, so the bottom line of all of this, is number one, if the company can deliver this very aggressive forecast, plus the sentiment around the company doesn't change, and it can retain this very high implied multiple, let's call it premium, by year end, the stock should trade up to $125 per share. So if the sentiment increases in in the company and the multiple goes up even more, then of course the company could trade to beyond $125 per share by year end. However, if the sentiment goes down and the implied multiple goes down, even if the company can deliver this highly aggressive forecast, it will not reach $125 by year end 2025. So keep that in mind. So I hope this was useful to put Palantir's valuation into context. It's a very interesting company. They have various unique, various USPs. They probably have in certain products even kind of a monopoly. However, the financial reality is it's a very expensive stock, and there are obviously risks involved in that, and it was the purpose of this presentation. I have no short position in the company or anything. I just wanted to provide some transparency. Thanks for listening. Bye.